Hello, this is Clark Kendall. Today is Friday, May 1st. I'm talking to you once again from my living room. Well, April was one of the best performing months in history since 1987 for the stock market. Coming off, as we all know, March was one of the worst. Big news over the last 6 weeks, over 30 million people, unfortunately, have had to file for unemployment due to the pandemic. That's approximately 1 out of 5 individuals in our country now are unemployed. We go back and read the history books, and this actually is very comparable to the Great Depression of the 1930s. I do want to point out kind of the positive of this, though, is unlike the 1930s, the government has stepped up and infused quite a bit of capital and money into our system through the CARES Act, the payroll protection program, the unemployment benefits. Enormous amount of money has gone in to support this economy. So when we do come out of it, we'll come out of it, stronger and quicker than we did in the 1930s. Dr. Fauci has pointed out that right now there are over 100 potential vaccines that are being worked on right now, and he expects by January 2021, we'll be able to distribute vaccines throughout our country and throughout the world. And I think that's what's been the positive news of what's gone on in the market in April. I caution people about the COVID success stories that I mentioned last week. Things like Gilead, Regeneron, Netflix, the Amazon. Google, these stocks have done extremely well, and I'm proud to say we've actually participated with them, but I worry about the valuations of these companies. These companies are trading at historically high valuations when you look at things like price to sales, price to earnings, valuation, because all investments boil down to return of cash flow and the predictability. I compared to the Y2K success stories, the Ciscos, the Qualcomms, the Intels, the GE Capital. Those companies also were doing extremely well and participated in the success of Y2K, but the valuations were very expensive. And those companies, even though they're still around, don't trade at the extreme premium. Even going back even further in the history books, the Nifty 50 of the 1970s, when I actually first started investing, back then it was Eastman Kodak, it was Hewlett Packard, it was Coca-Cola, those two. So I'm cautious in the marketplace. I do think there is investment opportunities in the market. The broad Russell 2000 is still down about 20% per year. And I do think that there will be companies that go out of business. Many of the retailers, such as Macy's, Neiman Marcus, are having very difficult times. They are not financially strong, and they're looking at potentially going belly up. So we've done our due diligence. As we pointed out in our last portfolio update, we look for the financially strong companies. So we pointed out things like debt to capital, current ratio. We want to make sure we own good companies that can weather this financial storm that we're in. And we think there's great opportunity. Things like United Rental and Discover Credit Card. That's what we're seeing as opportunities in this marketplace. Over the last few weeks, we've had the great opportunity to talk to you, to WebEx with you, to email with you. I cherish those opportunities to spend time with you, to help you spend time with your family, and so that we can all get through this in better shape than we are today. Look forward to speaking with you soon. Take care.